One mortgage burns $533,000 in interest. The other burns $207,000. Same house, same loan. A $326,000 difference. So the 15-year mortgage should obviously win, right? Not so fast. Because when we invest the extra monthly cash, the answer gets almost ridiculous. Today, we are doing the real math, so you do not choose a mortgage by feeling. Here is the setup. A $400,000 mortgage. The 30-year loan is 6.75%. The 15-year loan is 6%. Realistic enough to make the trade-off honest. Same house, same buyer, same 30-year finish line. The only question is where the cash goes. Start with the 30-year mortgage. The payment is $2,594 a month. Comfortable compared with the shorter loan. But comfort is not free. Over 30 years, you pay $533,981 in interest. That is more interest than the original loan itself. Now the 15-year mortgage. The payment jumps to $3,375 a month. That is $781 more every month. But the interest falls hard. Total interest, $207,577. Interest saved, $326,404. This is why people love the 15-year mortgage. You look at that number, and it feels like the debate is over. $326,000 saved. Paid off in half the time. More peace of mind, less debt. And honestly, that is a real win. But here is the part most people leave out. The 15-year payment is not magic. It is a forced extra payment of $781 a month. So the fair question is not 15-year versus 30-year. The fair question is, what happens if the 30-year borrower invests that $781 instead? Quick pause. If you like real numbers instead of finance slogans, subscribe. It is free, and this channel is built for exactly that. So let us invest the monthly gap. $781 a month. Simple index fund assumption. 8% a year. No trading, no genius, no perfect timing. Just automatic investing. After 15 years, that side account is worth about $270,000. And that matters, because at year 15, the 30-year borrower still owes $293,000 on the house. That sounds bad. But they also built a $270,000 portfolio with the cash they did not send to the bank. The gap is much smaller than the interest chart made it look. Now, run the whole 30-year race with the same monthly budget. The 30-year borrower keeps the lower mortgage and invests the $781 difference for 30 years. Portfolio at the end? $1,164,000. The 15-year borrower pays off the house in year 15, then invests the old mortgage payment for the next 15 years. Portfolio at the end? $1,168,000. The difference is $4,000 on a 30-year decision. $4,000, not $326,000. Not a landslide. Basically a tie, if the 30-year borrower actually invests the difference every single month. And that is the huge catch. Mathematically, the 30-year mortgage can compete. Behaviorally, most people do not invest the difference. They spend it. A nicer car, a bigger lifestyle, random upgrades. And if the difference gets spent, the 30-year mortgage loses badly. So, the 15-year mortgage is not just a loan, it is a discipline machine. It forces the extra $781 into your house every month. That can be perfect if you know you will not invest the gap. But it also removes flexibility. If you lose income, you cannot skip the bigger payment just because the math spreadsheet looked clean. The 30-year mortgage is the opposite. Lower required payment, more breathing room, more investing flexibility. But only if you treat the difference like it never existed. Automate it the same day the mortgage leaves your account. Otherwise, the spreadsheet was a fantasy. So here is the real rule. Choose the 15-year mortgage if you want guaranteed debt payoff and forced discipline. Choose the 30-year mortgage if you will automatically invest the difference and value flexibility. The best answer is not the shorter loan. It is not the longer loan. It is the one you can actually execute for 30 years. And one more thing. Do not buy the biggest house a bank approves. The real wealth move is not 15 versus 30. It is keeping the payment small enough that you can invest no matter which mortgage you choose. If this made the math click, subscribe. And watch my leasing versus buying a car video next. Same idea, a payment that looks normal but quietly costs a fortune. See you in the next one.